Okay. Well, everyone, thank you so much for joining us today. My name is Eric Bahn. I'm one of the co-founders at Hustle Fund, and today's session is called Forecasting for Early Startups. So when I was a kid, I dreamed about having a superpower. And most kids, when they're little kids, want to have super strength or the ability to fly. But what I wanted was actually the power to see the future. And boy, would have been useful in my life later on. I could have invested in Bitcoin in 2009, GameStop in 2020. But, it's not just about the self-compensation. Of course, I would have done good deeds too. Maybe like it stopped a natural disaster or something. So, founders are, interestingly enough, expected to have also this superpower, the power of being able to see into the future, but in a different way. They need to ask themselves every day whether they are going to be able to survive on the cash at hand. Today, we're going to hone that superpower with this awesome introduction to forecasting. And we have an amazing speaker whom I'm going to introduce in just a moment. He may look like a familiar face if you've been to the previous session. The speaker will walk us through this important topic. Let's go ahead and go to the next slide here, because what I want to do is first call out that these sessions that we host here, this monthly series of webinars on fundraising, startup growth, company building, doesn't happen with just Hustle Fund alone. We actually need to rely on awesome sponsor support. And we've had great partnership with NetSuite to date. I want to take a moment to just share a little bit about what NetSuite is all about. Facilitating growth within your business requires strong financial management and forecasting. But often those planning processes become labor intensive and time consuming. NetSuite helps startups avoid the intense labor associated with financial forecasting by centralizing core financial and operational data so that you can quickly and easily produce budgets and forecasts, model what-if scenarios, and generate reports within one collaborative solution. Real-time visibility and built-in financial reporting capabilities make it easy to make adjustments on the fly. NetSuite ensures you have a strong financial backbone to support even the most ambitious goals for your company. And with rapid implementation, you can simplify your budgeting and forecasting processes in no time. To learn more about NetSuite's financial solutions for startups, please visit netsuite.com. So many companies within the Hustle Fund portfolio today are using NetSuite. They're happy customers. So I hope that you check out netsuite.com. Thank you so much to our sponsors. Let's move on to that next slide there. So what I want to do now was to talk about what we're going to be covering today. I'm going to be introducing today's speaker, who is Miran Ahmad. He is incredible. If you went to our Finance 101 session a few weeks ago, he's hilarious and very informative. I'll share a little bit more about him in a moment. We're going to get right into the topics. There's some forecasting material that Miran has put together. It'll be really fun to sort of talk through his thoughts on how to approach this early founder. And let's leave plenty of time at the end for your questions. So let's go ahead into the next slide. One sort of logistics thing I'll mention. We also have my colleague, Mike, who is our head of product, who's going to be serving as our moderator for today. So if you have questions, please pump them into the Q&A section, not so much the chat. And if you're in the chat, definitely talk about us behind our backs and make snarky comments. We love that
Correct.
stuff. Tell us where you're based. But please direct your questions to the Q&A. We'll try to use that area for moderating at the end. So I'm really excited to introduce our speaker for today, Miran. Miran is a former investment banker who saw the light and left the profession to become a finance executive. He's been a rock star CFO at so many amazing companies in his career. Most recently, he led finance at Truepill, which is a rocket ship in the health infrastructure space. And now he's doing some consulting work under his company CFO. That's SEEFO.com. Highly recommend if you need an amazing advisor in terms of understanding your finance strategy. And not only that, Miran is just a wonderful teacher. He ran our Finance 101 session just a few weeks ago. It was so well received that I essentially had to beg him to come back and say, this is so good. Can you please do this again, but talk about forecasting, which is a topic that is an area of such frustration for so many founders. And he threw us a bone. So and is doing this again. So Miran, it's great to have you here. And before I let you sort of jump off and begin your talk, I also want to call out the fact that you were responsible, I believe, for bringing NetSuite over to Truepill back in the day. I hope that it was a good experience and helped you with forecasting and other
Great experience. Great experience. I did vendor selection management, all that stuff, interacted with a bunch of ERPs and players, narrowed down the focus, really enjoyed working with the NetSuite team, ended up choosing them at Truepill, and, super excited about that.
Well, awesome. Thank you for that. Thank you for the shout to our amazing sponsor as well. And let's let you take it from here. Teach us forecasting.
All right. Thank you again, Eric, for the kind words. Thank you again for having me back. For those who joined us for the Finance 101 session, hello again. For those who are new, I'm going to take you back on a few slides from our last session. Why? Mainly because I'm a glutton for punishment, but more realistically, it's because the model that we're eventually going to be going over, it talks about a lot of the data that we talked about in our last session. I tried to bridge that transition from kind of an academic exercise that we did in our last finance session to more a tactile exercise, right? You're going to see the golden formula at work. You're going to see how the three statements are interconnected. And more importantly, you're actually going to see how customers A, B, and C interact with all the three statements. So if you joined us from the last session, you're going to recognize these slides. If you're joining us for the first time, well, then I'm hoping this is also useful for you too. Right. No presentation of mine wouldn't be proper if I didn't try to sneak in a meme or two. So just when you thought you can get away from accounting, I'm going to pull you back in, right? And this kind of harks back to the lessons we talked about in our last session, which is how important it is to have good, clean financials, right? To have that accounting basics, because a lot of the projections that we use are based on the historicals and then adjusted kind of accordingly based off of, present trends, or if something was a one-off, we can adjust for that. But it's a great place to start. Right. So where did we begin last time? Right. In last session, we talked about the accounting Gordon formula, right, which is assets equals liabilities plus shareholders' equity. And when we looked at it from a pure academic perspective, right, and we briefly discussed the three statements and the kind of questions with the answer, right? So from an income statement perspective, how much money did I make, or how much did I lose, and what did I spend my money on? From a balance sheet perspective, right, it's how much money do I literally have in my bank account, and maybe who do I owe money to, and who owes me some money. And then lastly, the cash flow statement, which is like, where did my money actually go, right? As a founder, they each answer different questions, right? So for me, I love all my three kids, right? The income statement, balance sheet, and cash flow statement the same, because they answer very different questions. And one may be useful at one time and another may be useful at another time. So this slide is going to be really important because you're going to see this actually in action, right? You're going to see how the statements are interconnected. You're going to see how my model, the income statement, go down to net income, how that flows into this balance sheet, because I have a three-statement model that I'll be sharing with you later. It'll also be available if you reach out to me. Just send me an email. I'm happy to share it. It's a training model, so I try to make it as basic as possible, but we'll go through some of the basics. And then lastly, we went through kind of customers A, B, and C. For those of you who joined us, this slide should look familiar. I kind of brought the three customers that we talk about with the three different billing cycles: customer A, customer B, and customer C. And all the metrics and financial statements combined. One of the things that will be different for this model and this exercise, I've actually introduced operating expenses, right? So if you remember from our last session, I left, you were just making revenue, everything's flowing down to net income. Now the question ends up becoming like, okay, how are you hiring? What other kind of other expenses should we be modeling? And how do you actually think about that? So let's get into forecasting, okay? So that's enough about accounting. So let's start thinking about forecasting. And I just have some caveats and some notes and some assumptions I want to, kind of throw out to the whole team. It's the model that works for you may not work for your friend who's also a CEO, right? Models come in all shapes and sizes. The sophistication of your model may range from very basic, but should be increasing over time as you dedicate more time and resources to it, right? A lot of you guys may be early stage founders. A basic model is really all you need right now. But as you get to a Series B, as you take that Series C money, start to invest in not only the accounting team, but also the finance team, right? People can and should have, different perspectives on the level of sophistication that's needed, the functionality, right? Every model is a little bit different. And so with that frame in mind, let's kind of start thinking about kind of a model, right? And you can create the best model in the world and it's already wrong. And that's really the first thing I want to talk to you about in terms of framing the conversation around modeling. And that's separating the model that is the noun, the object, with the act of modeling, right? And it's that line can be blurry. So I'm going to make it very explicitly clear. It's the model will always be wrong. The model I'm showing you later will be wrong, right? The model you create for your company will always be wrong, and especially at the early stages. And that's because you may not have enough historical data, or the data, the clients, the historical is too homogenous. You may be working with friends and family, people who your customers are friends that you've known. So it's not representative of a steady state business, right? It's also built in with thousands and thousands of assumptions, both explicit and implicit. And I'll try my best to actually show you some of them in the model so you can start to get a grasp of, okay, I understand what he's trying to say, right? And then it's because it's very assumption based, you're kind of subject to garbage in, garbage out, right? And that kind of goes back to, you want to have a kind of clean historical data so that at least you have some base for projecting into the future, right? So if the model is always wrong, all hope isn't lost though, right? The act of modeling is invaluable, right? And the model gets better with time and engagement, right? In the future, the model should be less wrong, hopefully culminating into the point where you have a pretty good, mental model of actually being able to create like the immediate future. But what I was saying is modeling actually forces you to think through the inputs, right? Actually put pen to paper, actually put down what you were thinking and codify it, right? If forecasting is the front end work, right? And should be complemented with actually actualizing the model, right? So we've predicted, we're predicting March of 2021. We should actually at the end of March, early April, we actually should actualize the model and see where we're wrong and close the loop for your projections. And one of the things it'll do is it'll really help you think through like, why were you wrong, right? It'll help you triangulate your focus as a founder, right? There's a really high opportunity cost of where you can spend your time. It'll help you figure out like, why was my model wrong? Was I wrong on revenue, right? Did you not land that deal that you said you were going to land? Did you spend too much money? Did you hire someone a little too early or too late? And it'll help you focus, okay, where do I need to spend my time to get this business kind of back on track? Because that's what the model should be kind of getting you. It's like this kind of guiding star. Even though it's wrong, it's pointing you in the right direction, right? So modeling tactically, what do I mean by that? There are all kinds of models, right? So the first one is bottoms up versus tops down. I see a tops down model as really like a macro check. That's something that you should have kind of already done before you jumped into the space you're in, figuring out like, do I have room to be profitable? Like, hey, start with this TAM and penetration rates and known metrics, is this new vertical or this new space, is it profitable for me to even operate in? Do I need to own 10, 20, 40% of the industry to make it work? Or does it, make sense to deploy capital in that vertical? Maybe, maybe not. But more likely, and the model I'll show you later on, it's a bottoms up model. And this is where we focus on a set number of levers, we sensitize them, and we make company specific assumptions. And here's my mid-prezzo plug. It's really important that you wrap your quantitative numbers with a qualitative understanding. You'll see this later when I talk about pitfalls. It's actually probably one of the biggest ones you can have. Is it's easy to model the future. You can just be like, step function is in the future, everything's up and to the right. But if you don't like sanity check that with a business, if the person who's creating your model doesn't understand, how business works, how, this actually interacts in the real world, then it's all just a hypothetical exercise. It's not going to be really useful to you. It's not going to be actually like helping you think about the future, right? So it's really, really important that whoever builds your model really understands the business side of things. And that's, generally where I tend to shine, right? The investment banking hat kind of comes out. So with the right structure, and that's actually matching your operating environment, the model needs to be functional, right? It needs to actually, the three statements, you need to see the business from three different lenses, as I mentioned earlier, right? The income statement, the balance sheet, and the cash flow. And again, each one kind of answers, different questions that can be useful to you. And last thing, it needs to be useful, right? If at the end of the day, it's so burdensome, so cumbersome that you'd end up not using it, then the whole kind of point of mentally modeling out this exercise, it kind of goes to waste. So the last time we talked about, this slide's about the pitfalls of modeling. And I want to be very careful that says, don't be, seduced by the dark side of like modeling is going to solve all of my answers, right? trying to capture every single metric in your model is going to make it so burdensome, so hard to update. It will distract you within the weeds when you actually need to be up at 30,000 feet, right? That's really not what your model's for, right? In my opinion, the model should help you think about the future world, right? If this, then that, holding everything else equal, right? Hey, Miran, if I introduce a new B to B to C line, what could that look like? What's one world in which that could look like, right? And in that exercise, if we work together on a model, we're going to be trying to focus on the 3 to 5 levers that really drive most of the output. And for the rest of the stuff, we'll just try to get a good assumption, good, clean, explicit assumptions, and take it from there. And it's an iterative process, right? As the months continue, we're going to constantly be updating the model. Another big pitfall is you try to make it non-GAAP. That makes it really hard to align historical financials with forward-looking. So when you're doing a liquidity, when you're trying to go fundraise, you want the model to kind of blend naturally with your historical financials. Another kind of pitfall I've seen is back solving as an exercise can be very interesting. Hey, Miran, what would it look like? What do I need to achieve to get to $100 million in revenue or blank? Great. It should be helping you think about the world. But I've actually been in situations where founders are like, I need the model to say this. And that starts to get problematic. And then again, as I previously mentioned in the slide before, it's failure to contextualize, failure to wrap this just numbers, right? And that's all it is a bunch of assumptions in like the real world. So when I see a model that has CAC decreasing over time, and Eric, feel free to jump in, like that's a red flag for me, right? Where it's like, unless you have network effects, strong network effects, right? Your CAC generally should be going up and to the right. I'm sorry, that's the real world. And so making sure that you understand these kind of the assumptions that are behind your model and why it makes sense, and that you can defend them both internally to your board or to your fellow executives, but also externally to your investors. You can be like, this is why this is happening. So the last time we talked in our accounting session, it was, what does good look like? And Eric kind of proposed the question this time was, can I afford that? As your finance guy, I'm going to say no. And that's just like out of force of habit, I'm going to say, no, you can't afford that. Realistically, the answer is obviously much more complicated. So the question is, how do we create like a mental model actually answering the question? And I guess my first question back to you would be, what exactly are you trying to afford, right? And that will help you kind of figure out whether you can actually afford it, right? Is it something tactile and small? Is it a computer? Is it a thing? Okay, yeah, we'll spend, do you have enough cash on hand? Are you trying to hire people, right? Is this something where you're trying to hire 6, 10, 20 people? Okay, well, that's more of a medium-term liability, right? These are people, you should never hire someone unless you can pay them for at least a year, right? We're in startup land, nothing's guaranteed. But you shouldn't be uprooting and hiring, and if you know you don't have enough cash on hand for a year. That's my general rule of thumb. These are people, they're human beings, they're employees. People are uprooting their lives, they're changing their career path for you, and they're believing in you, giving up God knows what to join you. You should have enough cash on hand to pay them for at least a year. Okay. And with that lens of what are you trying to afford, I'm going to kind of introduce this concept of asset liability matching. It's something that I hope you keep into the future, right? And so kind of referencing back of, okay, are you trying to pick up, what kind of asset are you trying to pick up? A building, machinery, people, needs to be matched with the right kind of funding method, right? So you can think about asset and liability. So in another way, this is your classic sources and uses kind of framework. And this is one area where a model can really help you visualize if you can afford something. And if the model says you can't afford it, what levers do you have to actually like get there? Maybe you need to raise some equity, maybe raising some debt, maybe changing billing terms, right? There are also examples where asset liability mismatch, causes a lot of problems. And for me, the clearest example is WeWork, right? Where they have as an asset, short-term leases with startups and other companies looking for flexible leases. But on the liability side, they have long-term like leases with property managers or buildings. And so that mismatch creates a lot of timing problems, as you've seen in kind of during the pandemic, right? I've already talked about kind of classifying people as a medium-term liability. And so you should be thinking through, do I have enough cash for at least a year? And I think as you grow up as a company, the question from, can I afford this thing should be, should I afford it, right? Many of you will go on to build out very successful companies, have plenty of funding, turn profitable, go public. Can is a very, functioning unit of an early stage startup where it's like I'm limited by your bank balance, which is totally fine. But as you continue to grow, as you continue to execute, really think through like, should I afford this thing? We're going to switch now to the model. Eric, can you see the model? Everyone, making sure that as I switched over, everyone can see it.
Totally fine. And by the way, this is going to be a deliverable that Miran is open to sharing after this session, and we'll remind you of that afterwards.
Yep. There's my my email address. My website sucks. It's just a placeholder for now. Before I jump into the model itself, again, some author's notes. This model will be wrong. It's made up of thousands of implicit and explicit assumptions. You'll see some explicit assumptions when I'm just doing A times B. You'll see something like that. But also just a bunch of implied assumptions, right? I assume you land all your deals on day one. I assume everyone gets hired on day one. Like all these things, even if you're off by one day, that changes the whole model, right? The second thing is this is a training model. This model is built purposely inefficient so that you can click through, you can see the formulas, you can see what's going on. Because from there, I'm hoping obviously as things get more advanced, you'll have a better understanding, but these are the basics. I want to show you a couple things that as founders, you should be reviewing the model, right? How do you quickly review, get comfortable with how it's built, right? So number 3 is like alt tilde, F2 and alt open parentheses, I'll show you. I've applied general formatting rules, which is if it's black, it's a formula, right? You shouldn't have to touch it. If it's blue, that's a number you can touch. And then you'll see from the tabs below, revenue, payroll, and G&A are inputs, and then hopefully the outputs are the income statement, the balance sheet, cash flow. And the last thing is you'll notice there are no historical financials. So how do we know if my estimates are reasonable? You don't. And that's kind of going back to the same example of you want to make sure your accounting is at least kind of cleaned up a little bit so that we can make really, based in reality assumptions about what is your legal expense looking going forward, what is your payroll expense looking going forward. So with that in mind, I built this model kind of for the SaaS founders. Again, for those who joined us for our last session, customers A, B, C, these should look familiar to you. One of the things from an archetype perspective you'll see is January is in column F, and no matter what tab you go into, January is column F. So why do I build it like that? So that here's control tilde. I can just look column F, even though these reference different tabs, I know it's pulling at least the right January column, right? F, 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 everything's F, right? So all of January 2020 are Fs throughout all my input and my output tabs, right? So again, that's control tilde. And that just lets me see like, what is this? And the reason you want to do this is because what happens if your guy did like this, right? He like shoved $1,000 in there. Well, why? Like, why didn't we model that $1,000? Why are you plugging a number? You never want like a hard-coded number and an actual number and a formula in the same and it be black. You can do that if it's blue so that okay, I can tinker with this thing, right? That's the first one, right? F2, what does this formula actually do, right? Basic Excel is just trying to figure out like, oh, okay, cool, this is just the sum. Okay, this is just that. And the last one is, okay, I actually want to go to this revenue F15, it's open bracket, control open bracket. So it'll actually take me like, how did I get to that 75, right? It'll actually, if you notice, it skipped from the income statement to the revenue tab. So let's start here, great place, right? So as I mentioned before, the 3 tabs below, revenue, payroll, G&A are inputs, income statement, balance sheet are outputs. You'll notice most of the things on this tab, the income statement are black because they're all formulas. Okay, so let's actually go to the payroll tab, the revenue tab, and we're actually going to start looking through customers A, B, and C. I've done it so that I've done the whole customer by itself, right? Again, you may want to batch all the bookings together, right? Customer A bookings plus customer B bookings plus customer C bookings, right? Again, this is where there's no right or wrong answer. I just happen to think through like from a customer level perspective. Okay, if you remember from our last session, customer A was $360,000 in bookings. What do I need to do, right? Formula, so it's black and hard-coded because we knew this was yearly, right? And so all this is doing is just grabbing each one of these guys, right? Nothing fancy. But one of the things you'll notice is that I've broken down revenue from not only subscription, but also one-time implementation fees, right? Just breaking that early on will help you kind of answer later questions when Eric asks you, what's your MRR, ARR? You don't have to scrub out kind of implementation, one-off fees and stuff like that, right? You'll also notice that I've also modeled out the deferred revenue, which is the biggest kind of liability as a SaaS founder you're going to be dealing with, and going to be the most important thing to answer the question, can I afford it? For SaaS founders specifically, it's going to be your billings, right? Are you billing in advance? Are you billing in arrears? Are you billing monthly or quarterly? Because really at the early stage, your ability to afford something is a function of the cash on hand, right? Eventually, later stage, you have to be profitable. You got to get there. In the interim, it's literally, did I get paid by my customers? And that's a function of your billings, right? Now, that's an offset against, do I really, am I offering too much of a discount to get that booking in advance? And that's just a finance math question that we can figure out, like how much is the right discount? If a customer is requiring 30% off, is it really worth it to get billed in advance, right? But again, you'll notice customers A, B, and C exactly the same from last time. I actually built this model, a rougher version of this to do the previous one. So really, I just did a little bit more work, made it look prettier, and then kind of did this all. But again, say you had some implementation fees, it's easy to kind of go through and add them here, and it'll flow through the rest of the model, right? And then you notice it goes to the right. We can kind of project out. Best practices is generally 3 years. I know that's hard, and you're going to definitely wrong out in the future years, but it's a good exercise to kind of think through that far, because one, it shows you think. To me, as an angel investor, I want to see that you're thinking about the future. I want to see, what are you thinking about unlocking in year 2, year 3? Why are you taking my capital? Now, on the expense side, your biggest expense, most likely as a SaaS founder, isn't going to be cost of goods sold. There is no product, it's payroll, right? And so really taking the time and really building out a payroll function by person. So as you get actual data, you should be replacing this with the person's name, their actual salary, their actual taxes and benefits, because this may include Medicare, Medicaid, Social Security taxes, state taxes. If you've got a 401k, if you're matching, that should go in here. But as a rough rule of thumb, taxes, benefits, other besides cash comp is about 15 to 20%, right? As a modeling exercise, you pick somewhere in there, you're fine. Once you hire people, actually get the right number, because payroll is payroll. It's going to be the same every month. So you can actually get this number right. The most advanced formula that I have is really down here. It's basically a sum if formula, right? It's basically saying, I need to know what engineering is costing me versus payment operations, right? And so you can kind of see, where am I spending some of my payroll? And then lastly, a check, just making sure that I'm not missing anybody, right? That the sum of all of the people that I've actually hired match kind of my department level, right? Because these guys, you'll notice, will go to COGS, and these guys will go down into OpEx, right? Focus on the places that are the biggest, right? OpEx centers or revenue centers. You notice that I picked revenue, right? For customers A, B, and C. I picked payroll because I knew that's going to be 80% of the expenses. As we move to the G&A tab, right? I'm just going, okay, what have I historically generally spent? If you had historical financials, this is exactly where you put them in. Oh, I generally spend about $500 on rent. Okay, I spend $100 on utility, right? And just like hard code them and move forward, right? Because how much am I spending here? $1,000. How much am I spending on payroll? $42,000, right? So like just orders of magnitude, where do I want to spend my time? If you've got pretty good assumptions about if historicals are pretty accurate, okay, then just move forward. You may have one-time marketing expenses or one-time legal expenses that you need to incorporate. Great. But again, you'll notice the architecture here is January is column F, right? Same thing here, F. I generally put in a day count just in case you do need to prorate something. So if you need to prorate someone's hire date or prorate someone's revenue, you already have like the physical infrastructure to like day count that, right? So we've gone through the revenue tab. We've looked at, okay, I've actually modeled out the $360,000, right? It's divided by 12, so I get 30 grand. What do I have this guy paid in advance? We went through kind of payroll quickly, figuring out, okay, how much am I paying? Quick rule of thumb, 15 to 20% on taxes and benefits gets me a grossed up salary. And then this person is salaried, so they basically get paid twice a month for 12 months. And then I've kind of just done some nice to have, figuring out where am I spending my money. One of the things is this model was built for SaaS founders. I had a conversation yesterday with someone within the D2C space, and the question was like, where do I start with my revenue build, right? I'm not a SaaS. I would start at the unit economic level. I would start of like, I have this box that I send out to somebody, okay, and I make, generally $85 and it costs me $26. And here's my inventory costs and shipping and labor and packaging, right? This may not be my revenue tab, but this may be the tab that my revenue tab references, right? Because right from the beginning, you can start to think about, okay, am I doing, 100,000 boxes, right? Or 1,000,000 boxes? And that'll help you think about it. But once you get at the granular level, it's really helpful. And I think, Eric, again, correct me if I'm wrong, it's super impressive when a founder knows the nitty-gritty details of everything, not only of where does it cost today, but where is it costing in the future and why it's going down and what their plan is.
Yeah, actually, I have a comment on this. So you're absolutely right, Miran. Like when we invest, so we do pre-seed and seed stage investments. So the expectation of sophistication of founders on forecasting and finance is actually relatively low for us. Most people are spending time just trying to build product, get their first set of transactions in to demonstrate that they're on the right path. But, Miran, I'm actually really inspired by a comment you made in our previous session on Finance 101, which was essentially like the takeaway I got from your talk was if founders can sort of up level themselves to the next stage in anticipation of needing to be there. So like if you're a seed founder who can already talk with Series A level sophistication about your finances, and then Series A person talking about Series B level sophistication, it actually does differentiate you quite a bit. It just makes me feel like that there's some assurance that you're going to steward the wealth that we're transferring to you in an appropriate way. I'll be honest with you, man. Like it is really, really messy and kind of random at pre-seed.
No, totally.
Models
agree.
are like a Google sheet of just we need this much, I guess, for hiring. And I was the same way.
Yeah, totally. And just kind of when I was plugging myself back in, so something like this where you say, "Oh, I'm opening up a new DC to like lower shipping expense." You're an East Coast based, company, and you're opening a West Coast based distribution center, and so now you have decreased shipping expense. Well, like the first thing I go is like, is your rent increasing? Like if you're opening up a new DC, right, I should see rent expense increase in that month or starting to ramp in that month. And that's something where, again, guys like me who kind of can wrap that qualitative and quantitative, really shine versus someone who's just building a model going, yeah, I'm going to decrease your shipping costs over time, right? Because really good investors are going to call that out. They're going to spot inconsistencies in your model. And one inconsistency, that happens, right? But when you start to get multiple inconsistencies, then they start losing trust that the model is actually like showing you something useful, right? It kind of goes against the trust. Okay, so we talked about revenue, we talked about payroll, G&A, all these inputs. Now let's start to go, where does it actually start to flow through, right? So you'll notice this is Control tilde, right? The revenue is built off the revenue tab. Cost of goods sold is really just a function of payroll and say rent. Payroll's got its own tab and G&A's got its own tab, right? So my rule of thumb is if you've got a separate line item here, you should have a separate tab modeling it out, right? With different levels of sophistication, right? Again, we talked about this before. This is much more important. Payroll expense is much more important. I'd rather you get that 100% right or 99% right and just be kind of right on G&A because it really doesn't matter. Even if you're off by 100%, it's okay. $2,000, $2,500, like, okay, doesn't really matter. So the question ends up becoming like, can I afford this in this current model, right? I have you being profitable. So then the question becomes like, okay, how many more people can I like afford, right? At what point does the model break? We can do that. Another question is, okay, we go from revenue all the way down to net income, $30,000. We're going to see that show up on the statement of cash flows, right? There it is, right? And it's actually pulling from the income statement, right? So if I do control open bracket, it pulls me back. It's telling me this is the source. From there, we add a little back depreciation and amortization. And because someone prepaid you, you've got a bunch of deferred revenue. In this example, you bought some computers and stuff that you're amortizing over time, but that's really why your cash balance went up by $398,000, right? So you started off $1 million. Eric wrote you a giant $1 million check, but your balance is almost 4. The statement of cash flows is telling you why, right? It's telling me because you were a little bit profitable, but because really somebody paid you a lot in advance, right? Looking at your balance sheet, what do I see? You've got a bunch of money, you've got some assets, so this is probably computer or furniture. But again, you have a bunch of money that the customers prepaid you. And then there it is again, there's your net income as it flows onto the balance sheet, right? And so that's where it's really important to understand where things flow from our last example, because now you're actually turning it from an academic exercise into a tactile exercise. If this is referencing out, if there, if the errors models are breaking, you at least know kind of where to poke and prod. The golden formula right here, right, is my check. Assets equal liabilities plus shareholders' equity, right? It's super important that all the checks that I have in my model are all just zeroed out. They're clean, right? Here's one. And so you'll notice a lot of the stuff is black because it's formula based. Some of it's blue because you don't know what exactly you're spending your money on in a given month. But I'm just projecting, for example, that you're going to spend $2,500 a month on just like random stuff, right? So right now, I'm going to flip it back to the deck. I'm going to open it up to Q&A because I know I went through a lot of the tabs really quickly, but I wanted to make sure that you saw, each of the inputs, that I spent some time thinking through the actual inputs. Okay, what am I making? Who's giving it to me? When are they going to give me the money? Okay, who am I hiring? When are they onboarding? How much are they actually going to cost me all in, right? As an employer, you pay employer side costs as well, right? It's not just their salary. And then kind of just estimating the rest, right? Like I said before, everything here is just like, okay, these seem like reasonable assumptions or based off historicals. And then actually seeing, can I afford it? And I think the answer to that question is looking at your cash balance, right? It's really looking at like, how comfortable are you in relation to your burn, right? Is this at the end of 2020, you got 1.3 million. Okay, is that 6 months of runway? Is that 9 months of runway? Okay, how tolerant are you of risk? If you want to hire some more people, obviously this number goes down. But with that, I'm going to end back on the deck, and we'll open up to some Q&A.
That's awesome.
There's a lot of talking, so I apologize. I know there's a wall of words.
No, this is awesome, and very much appreciate your walking through us through this awesome forecasting 101 talk. Just a reminder that, and we'll say this again at the very end, that the model that you saw that Miran was working through is actually something that you can get for yourself if you contact him at Miran at seefo.com. After today's session, he's kindly actually spent this week actually producing it for you, so you can have it. Yeah. Before we jump into the questions, and again, a reminder that if you have questions, please pump it into the Q&A section of your Zoom panel. As those are sort of spinning up, I want to make a comment from an investor perspective about why I think this talk is so important. So when I went out and tried to fundraise back in the day, my model was basically like a single column. It was like payroll, benefits, like hardware expense, blah, blah, blah. It was like no formulas, all hard coded. And then it came up to like several $100,000 that I wanted to raise. It was so janky, right? But with just a little bit more sophistication in investing in like the forecasting side, it actually does inform how much you need to raise, because I'm actually starting to conclude that founders either are going way over or way under what they actually need to raise. So what's the consequence of that? Let's say that like my colleague Mike starts a company and he raises too much money. Well, he's over diluting himself. He's selling way more of the cap table than he actually needs to hit the milestones necessary for another fundraise at better valuations later. If he's under forecasting and then raises too little, then he might be in a situation where a few weeks before he's about to run out of cash, he has to come to me and say, like, can you loan me or give me a little bit more cash right now? It's a thing of desperation. Actually, on that one, like a really quick side story, we had a company that's now doing quite well, fortunately, who did not get this. And they under forecasted the day before Christmas. This guy said, can you please wire $5,000 to my bank account? I'm about to run out of money in like a week. And the first question I had was just like, why the hell are you telling me this now? But it's one of those things where like, it kind of creeps up on you if you're not really disciplined as an early founder of just like, I'm about to run out of cash and I didn't realize this. Anyway, that's my VC rant towards you. But we can actually get into the questions right now. And we have about 20 minutes or so.
Yeah,
And maybe we can start with this one, Miran. So we got an attendee who's asking, can you speak more about COGS for
yeah,
SaaS companies? Which items do you think belong there?
sure. GAAP is an interpretive based accounting construct. So great question on like what's included in COGS and what's not. I think the biggest piece of advice I can give you is if you have public company comparables, multiple public company comparables, look to see what they do, right? Because their financials have been audited, vetted by audit partners, big four firms who have signed off on, saying, I'm comfortable with this accounting policy. I'm comfortable with this being in COGS or being in OpEx, right? I happen to choose, say, this was more for like a fintech company who had payment operations, right? So actually delivering the good to the customer requires, you having some customer service representatives like helping the end customer. And so I've included their payroll here, right? So payroll F25 is me saying, oh, this one payment operations person is actually a COGS, the rest aren't. It's completely reasonable to have no COGS, right? That's the beauty of SaaS businesses. There's no physical tangible goods. It really depends on kind of accounting interpretation, right? I've seen everything from employees and their stock options being in COGS to having no COGS at all, to having somewhere in between going, your AWS expense is what is really required to be part of your SaaS business. So it's your cost of revenue and everything else is below the line, right? So take a look at public companies. And the best part is if it works either way. If all the companies are doing the same thing and they have the same kind of accounting structure, that gives you confidence like, okay, I should probably be doing it that way too. Especially if you're verbally comping against them, going, oh yeah, we're like the startup version of this company. If you've got multiple kinds where it's like some include COGS and some don't, then you can kind of pick your flavor, go, well, they did it this way. I'm going to be more like them. They must have gotten it cleared. And then really thinking through just because they did it doesn't mean you can do it, but it gives you at least some sense of confidence that like someone's cleared this, their partners thought it was okay. So I'm going to do it for now. And then constantly checking to make sure that's still okay per GAAP guidance.
Thank you so much for that. This next question actually comes from Daniel. I'm hoping that you and I can tag team this one. I'd love to take a track at first, actually. So Daniel's asking, can you walk us through some best practices for accounting for revenue cash flows when calculating the total raise? Now, again, like here's philosophically, I'm not going to, okay, I can't directly answer this because I actually honestly still kind of suck at, cash flow and and accounting myself. But I'll say this is again, just a reiteration that I think you need to raise as little as possible to comfortably get to the milestone that you're trying to reach before your next raise, right? Yep. So here's like a really, really super clear example. If you're running a SaaS business right now, if you can hit somewhere between like $1 to $3 million of annualized revenue, is right now the range that feels healthy-ish to get to like a Series A fundraise in many cases, at least with like tech companies that we've been seeing, right? So think about that milestone. It's like I'm running a SaaS business. What resources are going to be necessary for me to hit that kind of milestone to raise that Series A? That's going to be like a $10 million round or whatever you need to just get to the next milestone after that. For me, I kind of start with like that kind of back solve. And again, protecting your cap table is everything, right? Like you don't want to oversell your cap table. In a previous talk I shared, which is you start to hit a little bit of a red zone if you sell more than 25% of your cap table before your Series A. If it starts to hit like 30%, maybe it's okay. But like if it's, 40%, 50%, that's a bit of a dirty cap table. It's going to be hard for Series A investors to say like, what can I buy now? What's left, right? So that's kind of one response here. But Miran, would love to get your perspective on like best practices for accounting for revenue cash flows when calculating the total raise, if you have some thoughts.
I don't, because it is company specific. I've obviously built in the model where it's like, oh, I'm going to go raise right here. Like I'm going to go raise $1 million, right? Like let's reach out to me separately. And I'm happy to answer that question because it is kind of industry specific. If you're a SaaS founder versus non, right? Like, it really will be kind of company specific. So please reach out. My contact details were at the back of the slide, and I'm happy to chat more offline.
Awesome. And a reminder that not only is the model going to be available, but probably in the next 24 hours, we're going to have the entire recording available for you too, in case you need to go back and, go 0.5 speed on what something Miran talked about. So from Kevin, what is your advice on projecting revenue growth into years 2 and 3? My concern is that we project revenue growth in year 2 or 3, and that gives us a false sense that we have more runway?
Sure.
Yeah,
Right.
Horizons
So
is a pretty interesting question. Yeah.
yeah, right. I built this model with 2020, and then, so is it Kevin? Kevin's asking about kind of what do I think about 21, 22, and 23, right? I generally, this kind of goes back to the previous question of how much are you, how much runway do you have? I mean, the general rule of thumb is 18 months of runway. So, this model, your fundraise that you just, you got a check from Eric for $1 million, it should last you probably into mid 2021, depending on how much capital you gave up for it. And again, the model's iterative, right? So at the end of you should be updating this model every month and figuring out, okay, how am I tracking against the model that I projected? You can also have different versions of the model, right? So there could be an optimistic model that you're sharing with investors who are saying, like, if you give me this money, I can hit these projections because I need to go higher. But I would absolutely have an operating model of going like, okay, where do I have some fat that I can like pull back? Where do I have some, if things don't go as planned, if I don't land that deal, where can I like tweak the model in my business to actually like keep the runway going longer so I can actually hit that milestone, go back to the investor community and go, my metrics are awesome, give me more money.
Yeah, thank you for that, Miran. Hannah, I like your question that just popped up here. Hannah's asking, what advice would you give for an early stage company trying to forecast about 3 years? For example, your revenue forecast for the next year may be based on one product, but you intend to add multiple products at different prices over the following 2 years. What would you suggest forecasting for a year with more specific inputs and then in later years use more generic assumptions? I'd love to take a crack at this one too, Miran, but you're the pro here too. So
yeah, please.
Okay, as pre-seed investors, there's sort of like a unfair thing that we're asking here. Let me actually just share, like, what does a venture backable business actually look like for us? Because it's very specific, and it's going to sound totally arbitrary. At our team, we need to believe that the company is going to be hitting $100 million in revenue by year 5. I know that sounds totally random, but we tend to find that actually for our businesses in our first fund that have hit like a breakout, especially in like SaaS, they've kind of reached those kinds of levels of performance by year 5 specifically, and are generally on the path to becoming a unicorn, right? So like if you're far under that by year 5, that you could still become a unicorn, don't get me wrong, but like it's like we need to be really sensitive that within the 10-year window by which we're investing our investors' dollars, that there's going to be a set of fast trajectory businesses that can hit that milestone. So that's one thought I want you all to think about as a takeaway here is that year 5, can my business hit 100 million? And is that an expectation for seed investors? I think largely as an asset class allocator, that is. The other thing though is this, which is when I see 5-year forecasts and possibly even 3-year forecasts, Hannah, my first take is like, this is all bullshit anyway, right? Like, I mean, like there's so many freaking assumptions that things have to go right. And that's fine. But like, I still kind of like seeing the exercise. What's your take on this, Miran?
Yeah, like I said before, the biggest takeaway is the model is going to be wrong, right? The model, but again, it should help her think about the future, right? It should help her think about what happens if, and again, I had a conversation yesterday that was very helpful in the sense of, they're B2C now, but they were going to go B2B2C. It's like, what does that look like? Well, we're building B2C now, and then in a year, we're going to go B2B2C. Okay, there's nothing saying you can't start, customer D in Jan of 2021, right? And that customer D is like Sephora, if you're a beauty market, okay, we're going to penetrate this market, but it's got to be complemented with, do you have the people and the OpEx to support that, right? From a logical like business perspective, if you say, I'm going to go and land all these like retailers, but I don't see any hiring on payroll, if I don't see any like account executives or salespeople, then again, that's that internal inconsistency. You should absolutely be thinking about different business models. You should be getting, investors excited about like, hey, we've got this really cool product. It's version A, it's an MVP or whatever it is. But once I get into their tech stack as a SaaS business, it should match with the product pipeline. Like we're going to build this other product that is very complementary to the product that we already sold on. And it's easy because we're already in that customer's tech stack and we already know it's a need. And we anticipate building this product out by then. And you can see it ramping in 2021 onwards. And then, right now, we tentatively have product C coming out and we think it's going to be built in about 18 months. That's great. I want you thinking 18 months in the future. Eric is completely right. It's all going to be wrong because who knows if things get delayed or customers don't adopt or maybe adopt quicker, right? But again, the whole point of a model is to help you think about the future world. What if I do get that model, that product out and it prices like this, what can my financials look like?
So let me pull back actually a little bit on my like total shade on Hannah. By the way, it was an excellent question. So thank you so much for raising this because it's an important topic. Is like, so at the seed stage, I think it's really hard to do this. And that's hence like the comment, like this is BS. Later on though, like if you're like a series B stage company or a series C, or even, about to IPO, I think there's more legitimacy of just like, look, we have repeatable processes here by which we actually grow our business. And like the assumptions are actually more grounded in data at that point. Yep. Right. Now here's the thing about like why this may be worthwhile to still do at the seed stage, even if like it's all going to be wrong, as Miran correctly pointed out, is just, it gives me a sense of confidence that you're trying to level yourself up to being like a series A or series B ready CEO when you can show me the kinds of inputs that you care about. Right. And the output expectations too, even though like, I know it's going to be totally wrong. It's almost like, if you've ever applied for a job at like McKinsey or Boston Consulting Group or one of these like fancy consulting firms, like they always ask you like these kinds of case studies, and their intention is to try to get a sense of how you think about business, right? And it's kind of similar here. It's just like, oh wow, like Hannah's actually very seriously trying to consider stewarding like this capital very well, and is already thinking like a Series A and Series B founder. So it is worthwhile.
Yeah. Again, the model itself is wrong. The act of modeling as a verb is very helpful, right? And again, not every model has to be external. This could be just an internal model that helps you think about like, okay, when do I need to go fundraise, or can I afford that? Should I afford that? Does my product pipeline match with my financial pipeline? When do I need to go fundraise? What milestones do I need to track? Again, don't go too out into the future, because that may be the opportunity cost of you're not executing today, but it is super important to start thinking about the world. What if I did this? What would my world look like? Holding everything else equal. Again, on the payroll example, everyone was hired on day one, right? That's never the case. So again, just explicit assumptions versus implicit assumptions.
Okay, I think we have time for a couple more questions here. Again, like if you have questions for Miran Ahmad, our CFO wizard who's talking about forecasting, please pop it into the Q&A if you can. I am excited about this next question because this looks like one of our founders who is posted anonymously. Thank you for this question. It's I'm getting asked for growth in financial models as I'm currently raising. Eric knows. I guess. Our business makes money via implementation fee. This will be non-existent in 1 to 2 years, and transaction fee, similar to Stripe. How do I make assumptions at an early stage that make an investor feel confident? Is it just based on ensuring I provide references on where those assumptions are coming from?
Depending on who the investor is, you may share an investor version of the model, right? So it's very common to have a very robust internal model, and then you share a few of the tabs, right? With, like a revenue tab. If I was as an angel investor or a Series A investor, I would ask for like the revenue tab. I want to see the actual assumptions, right? And just sanity checking that against institutional knowledge that I have in hand, but public company knowledge that I know. Go, okay, like implementation fees for this kind of business range for 5 to 10. Okay, they're similar, okay, cool. Sanity check going, their implementation fees seem reasonable. Their usage fees seem reasonable, or whatever it is. And it's completely reasonable to have that kind of, we've got a bunch of one-time implementation fees that as we get implemented into someone's tech stack, and then it all kind of goes away because they're one time, but then we kind of make it up for it in terms of usage fee or whatever per transaction fee, depending on your business. And that's great. You should break those out both on your QuickBooks or your accounting system, but also on your model. So you can really highlight to Eric or any kind of investor going, look at my ARR, look at my MMR, right? Really know your business and show like, this is going to be a 10x business. We're going to do, whatever.
I totally know which company this is, by the way. I'll text you later. But like, just like one idea here when it comes to references, which I think is actually the key thing, is like the context of the industry might matter here too. So if there's ways to educate other investors that this is actually like how this industry works in terms of fee structure, and my business is sort of like modeling or like imprinting sort of similar kinds of patterns in terms of how we're growing as well. I think there's a little bit of that education is probably needed of just like, I'm in this like very specific space that operates like this, right? So if you're new to this industry, that's kind of how it operates too.
Yeah.
By the way, so I got a new testimonial for you, Miran.
Yeah.
So I see Brittany in the chat. I'm going to call you out. She says, this model template has me salivating. Can't wait to play around with it. It's so valuable. Thank you for putting it together, Miran.
You're very welcome.
I can't think of a better testimonial to just, print on a t-shirt,
Yeah.
So,
yeah. Thank you, Brittany, for that. I appreciate the kind words. Again, it's a super basic model. So hopefully what you can do is if you take that model, click around F2, control tilde, control open bracket, see how it works. And whoever you decide to end up working with, either you do it yourself, you work with someone like me, you work with me, exactly. You can build on top of it. You can build the cool charts, you can build the waterfalls, but it all starts with the basic model of do I understand what's going on? Do I know how things flow? I may not have a finance or an accounting background. I'm hoping this model can teach you oh, this number shows up here. Okay, that's cool. Also, in the case of if the model breaks and your finance guy's not around, that you can maybe just stumble your way through it, right? At the end of the day, I want to make sure that it's useful and effective to you.
Well, let's take just one more question here, and then we'll wrap and give people some reminders of how they can take this thirst trap model into their own ownership. Yeah, I have a little niece who's been teaching me all these Gen Z terms lately. So
I'm not hip. I'm not cool.
We're just like you now. So, yeah. Okay. Robert asked a question. How do you think about the difference between planning and forecasting? There's so much in these types of models where expenses are going, but when it comes to capacity modeling, Excel is simply not capable of helping you understand scaling staff methodically based on revenue. How do you handle that?
Yeah, I think for me at an early stage company, right, planning is great. I think that's a function of but it already kind of assumes you have kind of your accounting set and your finance set in the sense of your historicals are clean. You're already kind of actualizing your model and figuring out what's wrong and where did I track and then I think of planning as almost that iterative phase of the model of okay, now I'm planning the future. How do I need to do this? You can build on a bunch of, depending on the industry, you can build a bunch of just sanity checks going, what is my revenue? What is my payroll as a percentage of revenue? How does that line up to industry comps, right? Over time, you should be getting scale, right? You shouldn't have to add one more person to add one more X million dollars in revenue. You should be able to scale that up. But again, that's a little more of a company specific, especially with usage, where if it's, for example, equipment based, if you can only do so much work with a piece of equipment, then you've got to buy a new piece of equipment. And now that second piece of equipment is very inefficient because you don't have the volume to support it. And so that starts to get into waterfall. But planning is absolutely, the end stage you want to get to, right? Because that's where you're going to start really holding people accountable, actually issuing budgets and going, okay, I'm tracking to that. That's a really forward topic. I would love to be in a space where early stage startups are talking about that. I really do see the operating model as kind of the rough version of that, where it kind of helps you think about how much can I spend, where can I spend it. But you may not have the time. You may still have an outsourced kind of finance and accounting function that they may not have the time to actually really do that kind of closing the loop and actualization. Again, absolutely, as you get to B and C, you should be having accounting personnel, but also finance personnel really helping you think about this.
Awesome. Well, I think with that, we're going to have to start to wrap this up. Thank you, everyone, for your amazing questions. So big thank you to our audience for spending time with us this morning, Pacific time, to talk about forecasting. Miran, you're the best. I'm so glad that you threw us a bone after I begged you to come back. And everyone, I think, sees why he's such a great teacher at these subjects. Now, very important here. Again, I said this 5 times already, but it's worth saying 6 times, which is that this model that Miran had walked us through is available to you if you want it. If you contact him at Miran at CFO.com or LinkedIn. He's very warm and responsive. So if he has some other questions, he can also be able to spend some time with you on some of that. He's an incredible CFO too. And some of you might be in stages of your companies where you may want to engage him on bigger projects as well. So definitely follow Miran and ask him for this. In terms of the recording of this presentation, we'll make it available in the next 24 hours. But with that, I just want to say one more shout to Oracle NetSuite. Thank you again for sponsoring today's session. And Miran, dude, you're the man. We're going to try to find other ways of working with you in the future. Thank you so much for this.
Thank you. Thank you, everyone, for joining. Eric, thank you for, again, hosting me. Again, to our themes of being helpful and useful, show me an email, shoot me a message on LinkedIn. I'm happy to share the model. But again, thank you. Thank you again, Eric, for hosting me.
Awesome. Miran is available at Miran@CFO.com. All right, everyone, stay safe. See you in the next session. Bye-bye.
Thanks, guys. Bye.